Yeah, good afternoon, everyone, and thank you for joining in this webinar. My name is Bhargav Buddhadev, and I co-manage the Emerging Giants small cap portfolio. The idea to host this webinar was to sort of educate you our holdings in terms of which stocks haven't performed in the last 12 months, and also educate you in terms of which stocks we have been adding in terms of new inclusions and what is our rationale for them. So let's start with the performance. So as you can see in the table below, if you look at the since inception returns for emerging giants and compare it to BSE small cap, there has been alpha of about close to 200 basis point. And this is despite the year-to-date returns of 51% versus 64% for BSE small cap. So what we are trying to highlight is that despite FY24 year-to-date performance being weak, the portfolio did generate an alpha. If we move on to the next slide. Yeah. So we wanted to break up the emerging giants performance across cycles. And what we have done is we've distributed the performance into two buckets. The bucket on the left-hand side shows the alpha generation, and the bucket on the right-hand side shows the negative alpha. If you look at the table on the left-hand side, what you can clearly see is that the emerging giants as a portfolio does extremely well times where the small cap index has seen a sharp correction. So if you look at the period of Feb 2018 to November 2018, you can clearly see an alpha of about 18.3 percentage points. And during this period, whilst the index had corrected by 22%, the emerging giants portfolio corrected by just about 4%. In fact, if you also look at the June 19 to May 2020 period, whilst the BSE small cap corrected by about 32, the emerging giants was actually positive 0.8. In fact, if you move on to the next bucket, which is the table on the right, you can see that whilst there has been negative alpha during May 21 to April 22, and negative alpha during March 23 to August 23, the absolute performance wasn't that bad. So if you look at March 23 to August 23, whilst the emerging giants gave a positive return of 23.5, the BSE small cap at that time had given a 34.6 percentage points return, and hence the negative alpha of 11.2. So it's been only one period, which is September 23 to Feb 24, where the emerging giants has given a negative return of about 3%, whereas the benchmark, which is BSE small cap 250, gave a positive return of 19.5, and that translated to a negative alpha of 22.6. But since inception, this has been the only period, the last 6 months, where the negative alpha has also accompanied with a negative absolute performance. Other than that, there has not been any negative sort of performance leading to negative alpha. In fact, March 23 to August 23, the performance was actually fairly okay at 23.5. And if you look at year-to-date till February as well, the performance on an absolute basis has been 21%, but it's just that the benchmark has given a significant return, and we'll come to what has driven the returns as far as benchmark is concerned. Next slide. So if you deep dive into the key emerging giants stocks which have not contributed to the alpha, what we can see is that there are 7 stocks which have delivered less than 20% year-to-date returns. And this has led to the overall giants being just about 21% year-to-date. So if you look at these 7 names, these names are Sera, GMM Pfaudler, CCL Products, Sundaram Fasteners, Orient Electric, Lao Pala, and Hawkins. So if you look at their 9-month FY24 PAT growth, it has actually lagged the last 3 years PAT CAGR. You can clearly see the column which has been marked in a dotted red line. You can see that the 9-month FY24 PAT growth has actually been lower as compared to the last 3 years PAT CAGR for these 7 names. We'll get into details in terms of why the performance has been weaker for these names and why we still hold these stocks in the portfolio. But if you look at the table on the right, we also had some big hits in terms of Safari, Mastech, and Greenlam, which have actually seen very strong share price performance. And that has primarily been on the back of strong PAT growth as well. So if you look at Safari and Greenlam, the 9-month FY24 PAT growth has been higher as compared to 19 to 23 PAT CAGR. So let's go into sort of these names which haven't delivered more than 20% return. So if we move on to the next slide, let's discuss Sera to start with. So if you look at the 9-month performance, that has been weak, and that is primarily led by the bathware segment. So the bathware segment has seen a muted growth of about 5% in 9 months FY24, led by a muted performance mainly in the third quarter. If you look at building material as a sector in general, FY24 hasn't been a great year for the building material sector per se, and that is mainly on account of unseasonal rains, weaker consumer sentiments, and also sort of delayed in terms of their application. So if you look at real estate as a sector, last 2 years have done fantastically well, but companies like Sera find their application coming in the third year. So to that extent, given that we are already in the end of the second year, we believe that FY25 will be a year where you will see strong growth coming in for building material companies. If we also come to Sera again, there were pollution control measures in NCR also, which led to some slowdown as far as revenues for Sera is concerned. And because the revenue growth was muted in 9 months, there also was a negative operating leverage which kicked in. So if you look at the EBITDA margins, they actually declined by about 50 basis points YOY in 9 months to about 15.3. But why do we still continue to hold Sera? So despite the slowdown in the building material segment, there hasn't been any market share loss as far as Sera is concerned. So whilst Sera reported a growth of about 5%, the industry growth was just about 3%, which means that Sera continues to gain market share. In fact, if you look at FY21 to 23, as a period against the industry growth of about 10%, Sera has actually reported a revenue growth of 22%. So it's only a sort of a transient thing, a temporary thing, where the industry actually did not see a growth, and that led to Sera also growing at just about 5%. In fact, if you look at the balance sheet of Sera, it continues to remain extremely healthy. The balance sheet has net cash of about 800 crores. And if you look at the intrinsic ROIC of the business, it is north of 50%. As I highlighted you earlier, that in the last 2 years, the kind of launches which we've seen in the real estate sector, we expect that to convert into sales for Sera in FY25. And hence, we sort of continue to assume almost 18% EBITDA CAGR for Sera over FY25 and 26. So hence, we continue to own this name. If we talk about the second name, which is GMM Pfaudler, obviously what has happened is that the agrochemicals sector in general has been extremely weak, not only domestic, but also global. There was also an impact of channel destocking globally, which has impacted GMM Pfaudler. And if you look at their order book has actually declined by more than 30% in December 23 to about 2,200 crore. And this is the reason why the stock has actually seen a decline in terms of share price performance in the last 6 months. If you look at their EBITDA margins also, in fact, because of the weakness in terms of revenue momentum, there was an impact of negative operating leverage as well, which led to EBITDA margins declining by about 20 basis point YOY to about 14.3% versus 14.5 in the same period last year. Now, why did we not sell and why we continue to hold? Again, coming back to the market share sort of argument. So if you look at their competitor, HLE, Glasscoat, and Sachin Industries, Sachin Industries obviously is an unlisted company. The performance of GMM Pfaudler continues to be fairly healthy, which means that GMM continues to gain market share. Despite being in a down cycle, if you look at GMM's consolidated international operations, in fact, the international EBITDA margins have improved by about 70 basis point to about 13.4. Remember when GMM bought over Pfaudler, the margins of their international revenues were in single digit. And now the EBITDA margins, despite weakness on the revenue front, continues to remain healthy at about 13.4. In fact, starting off FY25, we expect order inflows to start coming in. In fact, our channel check suggests that in the fourth quarter, you should see order inflow growth on a Q-on-Q basis, and that could be a strong number. In fact, in the third quarter as well, they did see order intake growth on a sequential basis. And overall, we are assuming a 23% growth in terms of order backlog by December 24 to about 20 billion. And that would mean that GMM should report high teens revenue growth post FY25. In fact, we are also expecting a closure of marginal manufacturing units in Western Europe and share of Poland rising in terms of manufacturing footprint, which means that the international margins should also improve by about 200 to 300 basis point from FY26 onwards. In fact, if you look at on a free cash flow yield basis, GMM Pfaudler now trades at upwards of 5%. Obviously, the query in the mind of the investor is that why did we not sell out? In fact, to judge these chemical cycles is very, very difficult. And we did not anticipate the weakness to sort of. But now, if you look at some of the data which is coming in, even from China, the first 2 months, January and February, have been very strong as far as China is concerned. So clearly, what we are trying to say is that the decline in chemical prices, which was being witnessed in the last 15 months, and because of which chemical companies have delayed their capex, to some extent, that cycle should come back as the prices start stabilizing. So Chinese companies were dumping a lot of chemical products in the last 15 months. And as the domestic economy recovers, there is an expectation that there will be domestic demand, and that would mean that the Chinese will sort of not cut prices the way they cut in the last 15 months. And hence, it should sort of lead into driving of capex for GMM's clients. If we move on to the next slide. The third stock is Continental Coffee. So if we look at the volume growth for Continental Coffee with the CCL, it has actually been fairly strong at about 14% in the last 9 months. However, the management had guided for about 20%. And as compared to that, obviously, the volume growth has been lower. Now, one of the reasons for the lower volume growth has been the equipment breakdown in Vietnam in Q2, and also the inability to ship volumes due to the Red Sea crisis. Now, both of these issues have been sorted out, and we believe that the volume growth as a result should start coming back. Also, what happened was that in 9 months, there was high share of spray-dried coffee, which was a drag on margins. So there were capacity constraints on the freeze-dried, which is a high-margin product. And now those capacity constraints have been addressed with the new plant getting commissioned in Vietnam. So clearly, we are looking at the product portfolio also improving in terms of mix starting FY25, which would mean that the margins would come back. Also, there was significant inflation in green coffee prices during FY24, and that led to working capital investment increasing. If you look at the net debt to equity, resultantly increased to about 0.7 in September 23 versus 0.6 in March 23. So why do we continue to own? We continue to own because we were expecting the capacity to double in FY25, led by 77,000 tons capacity coming on board. And that is absolutely in line. So clearly, as that capacity comes on board, we should see encouraging volume growth coming back. In fact, their consumer business, which is the Continental Coffee brand, continues to do very well in India. They've already reached about 200 crores of revenue, and they have high single-digit market share pan-India. In fact, in South India, the market share is already at about 10%. Also, if you look at CCL as a portfolio, they continue to do extremely well. So they haven't lost any customer in the last decade, and that track record continues. So as far as market share is concerned, there is no loss in market share to that extent. So hence, we continue to like this name, and we continue to own Continental Coffee. The next stock is Sundaram Fasteners. So obviously, FY24 has been a disappointing year. So if you look at overall revenue growth, has been flattish versus an expectation of about 16% growth. And the main reason for that was the strike which happened in the US. So there was a United Auto Works strike in US, and this actually led to disruptions in terms of business operations. Also, there were inventory corrections which happened at the customer end, and also the crisis impacted the exports of Sundaram. All of these issues were actually transient, and we expect over the course of FY25, the growth to come back to about 20 to 25%. The performance of the Chinese subsidiary was also hit due to COVID-19 related lockdowns in China. So we obviously saw that the Chinese economy was not doing well at all in the last year, and this also impacted the performance of the Chinese subsidiary. Also, the wind in the industrial segment, which is a bit cyclical in nature, got impacted due to the slowdown in Europe. But why do we continue to like this name? We continue to like this name because they are a play on the EV sector as well. So they've already started getting orders on the EV front. In fact, they won an order of about $480 million for drive gears, shafts, and other components on the vehicle side. The revenue generation will happen over the course of next couple of years. They continue to build a value-added portfolio, product launches, and increasing wallet share in their existing products. So net, we are expecting close to about 20% plus growth in Sundaram Fasteners over the next 2 years. And hence, we continue to sort of like this name. They continue to enjoy oligopolistic kind of an environment. And the good part is that they not only have manufacturing footprint in India, but overseas, which makes them a fairly dependable vendor. If we move on to the next slide, Orient Electric. So if you look at Orient Electric, in fact, the performance hasn't been bad at all. If you look at the comparison with regards to their peers like Havells, Crompton, they have actually done fairly well. The main issue with Orient was that the main business comes from fans. So fans occupy about 50% of overall revenues. And the industry has been going through a change. So there were star-rated norms which were imposed in fans last year, which is January 23. And resultantly, what happened was that there was inventory liquidation at the dealer end. So there was inventory at the dealer, and they were liquidating because they are now not allowed to sell star-rated fans come March 24. So clearly there was a liquidation which was happening, and this impacted the primary sales not only for Orient, but all the players in the industry. Alongside that, Orient also implemented a change in their distribution. So they were mainly a master distributor-led franchisee. They rolled out direct to market, and that led to some transient loss in sales. In fact, in states where they've already rolled out direct to market, they're already seeing more than 50% revenue growth. And this strategy from a long-term perspective is very, very good. In fact, Havells had launched this about a decade back, and they are still realizing the benefits of direct to market. So clearly, as Orient is launching direct to market, they should sort of reap the benefits of this also in the next 4 to 5 years. Lighting as a segment reported sluggish growth of about 6%, and this was the case with the industry as well. So whilst the volume growth has been strong in double digit, but because of the price erosion to the tune of about 15%, the revenue growth has been sluggish. But the main reason why Orient actually saw a correction in the stock price has been the CEO leaving the company within 3 months of joining. So actually, there was a judgmental error on the part of Orient to hire that CEO. But now it's only a matter of time that the new CEO will be soon joining the company. And as the new CEO comes in, we expect the stock to get re-rated. In fact, in FY25, we are looking at north of 30% growth for Orient, led by channel restocking in fans. Also, the Hyderabad capex, which got delayed because of Chinese visas not being given. So they were sort of expecting the supervisors from China to come and commercialize the factory, but that got delayed. But now those visas have been sorted out. The commissioning of the factory is likely to happen in June. So clearly, as the Hyderabad plant starts getting commissioned, you will see market share gains happening in South India as well. And as they roll out and stabilize the direct to market piece, you will see a strong growth coming in states where direct to market has also been rolled out. So net, we're looking at north of 30% growth for Orient. And as the CEO comes in, we look at steep improvement in terms of share price performance, led by PE getting re-rated as well. If we come to Laopala, obviously the growth for FY24 has been fairly disappointing. So the revenues declined by about 18% YOY. Again, company-specific reasons. So they have made channel corrections similar to what Orient did. And they also did not get an institutional order from a large corporate. So last year, they had booked about 50 odd crores of institutional order. And this year, they did not get that order, which led to their revenues sort of declining. But why we continue to own channel correction measures obviously will reap benefits. So FY24 was a transient year where there was loss of sales on account of channel correction. But the channel correction piece is now sort of fully addressed. And we believe that post this channel correction, they should again start getting market share gains. In fact, the borosilicate plant, which has also got commercialized, that would sort of help Laopala in terms of completing the portfolio. So the immediate competitor is Cello. They had a presence in borosilicate. Laopala did not have this presence, but now with borosilicate, the portfolio is complete, and resultantly, they should start getting good business momentum back. In fact, if we look at their free cash flow yield, it is in excess of 3%. And the fact that they have almost 500 crores of net cash gives a lot of margin of safety and valuation comfort. The next name is Hawkins. So Hawkins also reported a fairly sluggish revenue growth of -1% in 9 months versus an expectation of 9% growth, which we were expecting. So again, the entire category, which is cooker and cookware, has actually not seen a growth in FY24. There was some pent-up demand during the COVID period, which sort of led to this revenue decline. Still coming in FY24. In fact, if we look at the competitors like TTK Prestige, they've also reported sort of a flattish revenue number. Alongside that, there was also some increase in terms of competitive intensity from regional players like Nidlon, Pigeon, Preeti. who had become aggressive in terms of pricing. But clearly, as the industry leaders have taken corrective actions on pricing, we expect the transient market share loss to sort of come back. In fact, Hawkins continues to have a fairly superior capital allocation. So the ROA continues to remain in excess of 40%. And the balance sheet continues to remain net cash at about 0.8 billion. So clearly, as revenue growth and market share comes back, we expect the stock price to sort of bounce back. Next slide. Yeah, so in terms of recent additions which we have done, there are three additions to the portfolio which we've done, starting with Moltech. So Moltech is a play on packaging. So Moltech supplies to three segments. One is paints, second is pharma, and third is FMCG. As far as paints is concerned, obviously, we are seeing significant competition in the paint sector led by Grasim sort of making a new entry. So obviously, there could be significant pricing pressure for paint companies. But what will happen is that they will want to differentiate themselves through attractive packaging. And Moltech is a sort of significant player in that segment. In fact, all the Grasim's manufacturing plants are going to get serviced by Moltech, and they have incurred a significant expansion as well, which is very close to where Grasim is setting up, both in north as well as in south. So clearly, Moltech will emerge as a very good beneficiary of the rising competition in the paint segment. The second segment is the FMCG piece. So in FMCG side, we are seeing strong improvements as far as hygiene is concerned. Just give you a basic example that earlier, when we used to have ice creams, we used to have it in paper cups, but that is getting replaced by plastic containers, which are with seal. So to that extent, Moltech is clearly a play on that optimization. And mind you, Moltech is a market leader across FMCG as well as paints in terms of packaging. And as both these sectors see strong sort of attraction in terms of revenue growth as an industry, Moltech clearly will be a beneficiary. In fact, they'll be now launching into the pharma space where they'll be manufacturing plastic containers. So if you look at Himalaya as a company, they supply medicines in plastic containers, unlike in aluminum foils where other companies supply. But we expect in the next 4 to 5 years, the entire aluminum foil packaging to get replaced by plastic containers, and that is where Moltech will be a disproportionate beneficiary. In fact, the EBITDA margins in the pharma space are disproportionately higher at about 150 per kg compared to about 40 per kg, which they do in the paints and the FMCG space. So clearly, Moltech should do very well. We are expecting north of 25% EBITDA CAGR for Moltech over the course of next 2 years, and hence we've added this stock in the portfolio. The second stock which we've added is Rajratan Global Wires. Rajratan Global Wires is a market leader in bead wire as far as India is concerned. They have almost 45% market share. 35% of the market has been imports. Recently, the government of India has come up with a quality control order, which means that the imports will sort of decline significantly, and that's a runway which will be used by both Rajratan and Tata Steel. Tata Steel is the other domestic competitor of Rajratan. So both Rajratan and Tata Steel should benefit from this quality control order. There is a 35% market in India to be captured. Alongside that, what is also happening is that a lot of these tire companies, which were mainly selling in the domestic market, will now sort of strengthen their export franchise as well. So in fact, if you look at the kind of capex which tire companies have incurred over the last 4 to 5 years, we've seen gross block doubling for many of the tire companies, because they are now also looking at playing the China plus one angle. So they have significantly expanded on their port-based capacities. And clearly, as they sort of increase their export volume growth, we should see Rajratan also benefiting. In fact, the Association of Tire, which is ATMA, is actually forecasting the tire companies to see volumes increasing from about 65,000 tons to 1,65,000 tons in the next 5 years. So clearly, we are looking at a very strong volume growth for tire company. Is a clear beneficiary, mainly because it's an oligopolistic market between Rajratan and Tata Steel, which means that both will sort of benefit, and both will also see improvement in terms of margins post the quality control order. Last stock which we've added in the portfolio is Venus Pipes. It is a challenger to Ratnamani Metals. They are into stainless steel pipes. It's actually a proxy to the industrial capex, which we are seeing in India. So rather than playing the asset-heavy business, we thought of playing the vendor to that particular industry. So Venus is clearly doing extremely well. In fact, we are looking at almost a 30% EBITDA CAGR over the next 2 years. They now also have a very strong export franchise. Almost 20% of revenues come from exports. They have made a very strong name in Europe, and now they are looking at entering into US. So we are clearly seeing a very strong revenue growth given their strong export franchise. And now with manufacturing and industrial capex also kicking in India, Venus could emerge as a strong beneficiary. Again, the story being that of import substitution. We are not saying they'll take market share for Ratnamani, but clearly they'll replace the imports. Let's now address the rally which has happened in small cap in the last 12 months. So if you look at small cap 250 as an index, that has actually given returns of north of 50% in the last 12 months. So what we did was we looked at the top 100 performers in terms of the index. So if we look at the top 100 performers out of 250, what we see is that these top 100 performers have seen a significant price appreciation. The price appreciation has actually been to the extent of 133%. Now, if you look at whether there is any fundamental backing behind this performance, we actually show you the data. There is actually no fundamental sort of drivers behind this stock price rally. In fact, if you look at the EPS CAGR for these top 100 companies over FY19 to 23, it is minus 4.6. Again, I repeat, minus 4.6% EPS CAGR. If you look at the return on equity for these companies, it has declined from 14% in FY19 to 9% in FY23. So there has been a 500 basis point decline in return on equity from 14% to 9%. The only silver lining has been the fact that the net debt to equity has improved from 0.8 to 0.4 from FY19 to 23. Now, the bulls might argue that clearly, whilst 19 to 23 performance has been weak, but what after April 23? So we've already seen 9 months of results. How has been the performance? Now, if you look at the April till date earnings growth for these top 100 companies, what we see is that the earnings growth is just about 30% in terms of improvement. But as against that 30%, the share price appreciation obviously has been much, much higher. So what we are trying to tell you is that clearly there is a lot of excesses which has been built up in terms of share price performance for many of these names in the BSE Small Cap 250 Index. And one has to be extremely careful of these share price performances. Now with SEBI sort of noticing this fact that a lot of these shares have gone far ahead of their fundamentals, we are seeing significant corrections happening across many of these names starting March. So clearly what we are of the opinion is that come FY25, quality should make a comeback. And if one has seen a very strong share price performance by having invested in these names, it's actually the right time to exit these names and sort of get into quality names. Because over time, it's been the earnings growth which has driven stock price performance and not vice versa. In fact, a lot of this share price performance of these 100 companies has been driven by extremely strong flows in the small cap schemes. So if you look at the column, the bar chart on the left-hand corner, you can see that over 20 to 24, there has been a significant increase in terms of small cap inflows, and that has actually led to this improvement in terms of stock price performance. Now, with SEBI coming with a strong warning, you should actually see large part of these flows into the small caps drying up. And that would mean that many of these names which have actually gone up significantly without any fundamental improvement will actually see share price going down. So share prices will start reversing. Another trend that we've seen in many of these names is the extent of low free float. So many of these companies which have seen significant share price appreciation also have fairly low free floats. In fact, a few of the names which we have mentioned on the table in the right-hand side corner, you can see that the free float in few names is as low as 11%, 17%, etc., etc. So clearly, many of these names could also arguably be cornered, and that would have led to significant share price outperformance. But as SEBI comes up with a warning, clearly many of these names may not find liquidity, and to that extent there could be sharp share price corrections in many of these names. And to that extent, our humble request is for the listeners to sort of shift to quality rather than being in these kind of names. If we move on to the next slide. So if we look at the portfolio of emerging giants as of now, we are expecting a 30% EPS growth for FY25 for our portfolio companies versus 14% in FY24. So the earnings growth will significantly improve from 14% to 30% in FY25. And also the return on equity will sort of significantly improve from about 17% in FY24 to 19%. So the earnings growth is at 30% and the return on equity is at 19%. One could say that these stocks are expensive. No, we don't believe that they are expensive. The reason why we say so is because if you look at the PEG ratio, which is price earnings to growth, it is just at 0.8, which means that if the P is high at about 24.4, the earnings growth is equally strong at about 29%, which means that we are sort of buying these stocks at fairly attractive valuations. Even if there is no PE re-rating in the portfolio, and if the share price follows the earnings growth, this portfolio has the propensity to give more than 20% upside as far as FY25 is concerned. In fact, if you look at the risk in terms of the portfolio, which we've shown in the table on the right-hand side, you can clearly see that the Sharpe ratio and the Trenner ratio for emerging giants is far superior compared to BSE small cap, which means that on a risk-adjusted basis, the portfolio is fairly suited as far as quality is concerned. So our humble request is to sort of look at quality because quality will come back and it will come back in a strong manner. In fact, if you look at the net debt to equity also for the portfolio is as such debt-free. So the net debt to equity is just about 0.02, which means that the portfolio does not have debt. So to that extent, if there is any uncertainty in terms of event risk as well, this portfolio is fairly suited in terms of drawdowns. In fact, when we started, we showed you the first slide where you can clearly see that if there is a downturn in terms of small cap correction, our portfolio is extremely well suited to protect their downturn. In fact, the downturn protection gives significant alpha generation. But given that we've changed our style to high growth in the last 6 months, You will also see this portfolio participating in terms of up move as well, because the earnings growth of the portfolio now is very strong. In fact, you'll see a couple of new additions also in the next 1 month. So we are gearing the portfolio to high growth, and we are very cognizant in terms of valuation. So we'll not buy high growth stocks at any valuations. We are looking at buying high growth companies at reasonable valuations. And we are fairly confident that the portfolio will come back in terms of alpha generation. So I'll take a pause here in terms of my presentation. Happy to answer questions if any.